Happy Friday, traders. This is Fawad Razak's dollar market analyst for City Index. Today is the 4th of July, which means that the US is out, obviously. But index futures are trading, and as you can see on the watch list, markets are down across the board, led by Europe. Now, European indices are down. As you can see, the DAX here is testing support at 23,735. This level being an important intraday level, if you like. We've seen lots of price action around this area. And this is also where we have the 21-day exponential moving average coming into play as well. Now, despite the weakness, the long-term trend is clearly bullish still, and we are yet to see any major bearish reversal signals. So this dip could well be bought once again, even if uncertainty about trade tariffs is on the rise again with the July 9 deadline approaching next week. I've written more on trade tariffs in the link in the video, so please visit that if interested to read more. Now, in the FX space, the US dollar has eased off the highs achieved yesterday when the jobs report was better than expected, causing the dollar to bounce a little bit. But sentiment remains quite negative on the greenback, and we've seen renewed selling in the likes of the dollar yen. The dollar yen is still holding above the broken trend line, and well, it was broken momentarily before it was reclaimed yesterday. It's testing that trend line once again and holding above that 144 to 144.25 area of support, which is going to be very important today to watch. If we go below that on a daily closing basis, that would be a bearish technical development, in which case we could well see some further weakness in the week ahead. The key area below that remains between 142 to 143.80, the shade gray region, where we've seen lots of bounces from in the past several weeks. Below that is the 140 handle, which is where I think the dollar yen could be heading down to in the coming weeks. Now, in terms of resistance, the dollar yen has held below the 145 handle, which is not displayed on this chart because there are too many levels to keep an eye on. But above 145, the next resistance level comes in at 146. 146 marking the low of this inverted hammer candle, this reversal looking candle that was formed on June the 23rd when rates topped out, and then we went on to get back down to the support area. So that level is now the most important resistance level in my view. And if we were to go above it, then I think at that point we'll have to drop our bearish view on this currency pair. Now, next week we have central bank rate decisions from the reserve banks of New Zealand and Australia, where rate cuts are expected. But the part of this resistance remains to the upside for the Aussie because of the weakness in the US dollar. If tariff uncertainty reduces further in the weeks ahead, this could well push the Aussie dollar much higher. For now, the key level that I'm watching is this blue line here at around 65.35 area, where it has been tested on a number of occasions previously before we broke above it last week, and we've held above it since, including yesterday when the stronger jobs report from the US caused the trade to dip into this level before it bounced back. So that level is key in so far as the short term is concerned. If we were to go below it, I think that could potentially pave the way for a drop to 65, which is the next key support, and below that is the head of this hammer candle at 64.63. On the upside, 66 is now the key level to watch in terms of upside targets, which is a round handle above it. There's not many other key levels to watch in as far as resistance is concerned until around 67, which is another round handle, and 68 and so on. But the part of this resistance continues to remain to the upside given a bullish price structure. For more market updates and insights, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.